Welcome to the Daily Update, where I'll go over the action in the market for Thursday, February 1st, and then we'll see how things look for Friday, February 2nd. We had a nice little bounce. We were able to recapture what was lost after Chairperson Powell gave his testimony or press conference on Wednesday. We didn't recapture the gap that we set earlier in the day, but the fact that we were able to bounce up just showed that maybe the market did overreact in Wednesday's session. We recouped a lot of that on Thursday. Unfortunately, our trend is having a little bit of a difficult time deciding, is it getting stronger or is it getting weaker, because we're dropping below the moving averages. We're still positive for right now. We still have an overbought condition. In Friday's session is going to be the big employment report, and that's probably going to hopefully give some clues as to what the market is looking for going forward. There's also a little bit of speculation. I've been trying to bring this up in the videos from time to time that, okay, we had the banking crisis last March, roughly 11 months ago, and now things seem to get better. Well, in Thursday's session, we had a few more problems start to emerge. Is that an isolated case, or is that going to be the beginning of something that's going to have more of an impact? We don't know at this point. So let's go back and talk about what happened. Right at the open, we had a gap higher open. The futures were pretty strong before the market even opened, and that carried over into the open itself. We opened above the daily pivot at 48.66. Prices hit resistance at 48.75. That's a round number, more or less. And then we fell back below the daily pivot. Then prices climbed back above the daily pivot. We got above R1 at 48.87, and we closed above 4,900. So we did recapture that level, and that is positive in and of itself. We were up 1.25%, so we gained still about a 0.5% short of where we were before Wednesday's session. So we gained a lot of that back, and we were above average with volume. We are positive with our technicals. It's still about inflation and interest rates and what's the Fed going to do. I have some charts to show you that might give some insight as to what's happening there. And then we have the geopolitical events. But as I've been saying, the market just doesn't seem to be paying attention to that, at least right now. Some comments that we can make. We did regain 4,900 for the S&P 500. And when we saw the move up, as the decline that we saw on Wednesday, that was like everything was being sold. Well, we saw more of a broad-based advance in Thursday's session to recapture a lot of that. And the mega caps actually did well, where they were more weak in Wednesday's session. This is the regional banking weakness that is coming out. The New York Community Bank, they were down over 11%. They're slashing their dividend, and there's some concerns about that bank, and so they quickly fell. Is this the only bank? Is there going to be other banks that come out after this? Is this the beginning of something? Or, as I said before, just an isolated case? On a short-term basis, where we were extreme negative with the rate of change from Wednesday to Thursday, well, now we're extreme positive from, it should be Tuesday to Wednesday. We're extreme positive from Wednesday to Thursday. We do have the Williams percent R and the stochastics, which are extreme positive. And I have a little problem with the keyboard that I use here, and sometimes it puts in two of these marks here. Intermediate term, we do have the PMO studies. They're still extreme. Some of them are rolling over below their moving averages. Some of them are looking a little bit more positive. So we're getting kind of a mixed picture there. The Sean trend meter, the NASDAQ 100 bullish percent index, and then our longer term new high, new low study. Now this list is a lot shorter, but we're still showing some extreme readings, especially when you look at our oscillators. And in the long term, we're also extreme with the 150 and 200 period simple moving averages. And I've taken out that line because it really has started to disappear, where the Fed might come in and raise rates if reports are stronger than expected. That doesn't seem to be part of their thinking right now. But we are still going with the idea that the Fed is done raising rates and that at some point they're going to cut rates. Now, we've taken March off the table, and the probabilities for that have pretty much fallen away. Now they're looking out towards May to see if that will be when the first rate cut actually happens. We still want to keep an eye on these economic reports. If they do really start to come in strong, that could come back into the Fed's way of thinking. The dollar was up and interest rates were down. We actually fell with the 10-year yield at 3.86%. So just a few days ago, we were well up over 4%. Now we're falling down, and this is also giving support to stocks. And the yield curves that we've been following now for a couple of years, they still are inverted. Sentiment is positive. We did tick up. We're not extreme. That's when we get to 75. We had been at 65. We got up to 70. So we're still positive and have a little bit more room to run before we look at using this as a contrarian indicator. Unless our charts start to show weakness, then we would go off of the extreme reading that we already saw previously. Our trend is positive now, but we're dropping below the moving averages. You get this big solid down day and then an up day, and that's like, okay, the ADX is saying there's no trend here. I'm not sure what to do, so I'm going to decline a little bit. It is dropping below its moving average. Our bias, even though we had the up day, I'm keeping it at mixed right now because we had such a solid down day on Wednesday and we didn't recoup all of that on Thursday. But I'm still keeping our momentum positive for right now. But a lot of that's going to determine how we finish out the week in reaction to the employment report. The reports that we did get in Thursday's session, we're seeing a tick up in weekly jobless claims. They came in at 224,000. Last week, it was 215,000. So we're starting to see this go back up, and I have charts of these to show you. The continuing claims also went up to 1.898 million. Last week, they were at 1.828 million. Then productivity, and this was taken as a bit more friendly for the market. We were still up 3.2%. Okay, that's the preliminary report. That's higher than the 2.1% that they had expected. Last time it came in at 4.9%. So it was greater than expected, but down from last time. The unit labor cost came in up 0.5%. This was a lot less. They expected it to be up 1.9%. Last time it was down 1.1%. And this one isn't all that influential. The big takeaway here is that we're above 50 when we look at global US manufacturing. And that's the final reading. We're at 50.7. That just shows a little bit of an expansion in the economy. Construction spending was up 0.9%, much more than the 0.4% they had expected. Last time it did come in up 0.9%. This was the big one. ISM manufacturing came in at 49.1. Okay, it's below 50, which is showing a contraction. But last time it was at 47.1, and it also came in higher than the 47.3 that they had expected. So even though we're still below 50, we are showing an improvement in this. Here are some charts. Here's the weekly jobless claims. We had been declining with our 4-week average. Well, now it's starting to turn up. So we're seeing a little bit of weakness here in the employment situation. The continuing claims also are starting to go back up, and the moving average is starting to go back up. We look at all of these together, where the red line are the initial claims, which is really hard to see. The blue line are the continuing claims, and then we'll get an update in the unemployment rate in Friday's session to bring all of that together. And we're currently at 3.7%. We'll have to see what comes out with the report on Friday. Then we look at non-farm productivity and unit labor costs, and this is what people like to see when you want the economy to be growing but not getting out of hand, where we're seeing productivity increasing, but we're seeing unit labor costs actually coming down. And that may not be very happy for your job. You'd like to make more and do less, but when you're a stockholder, you want there to be more, and it costs less to be able to do that. Then looking at construction spending, which is continuing to go up here on a year-over-year basis. The ISM index, where the blue line is the total, where it is increasing, but we're still below 50. The orders are showing some improvement, so that's suggesting there's some economic strength there. The ISM prices and deliveries, the blue line are the prices. We were pretty much flat, where we saw an increase in the deliveries. And then imports versus exports. The imports, that's the yellow line here, where it's showing a bit of an improvement, where we were flat. with the exports, and then looking at this as it's been increasing a little bit lately when we take the whole ISM together. Some blog charts that I found from Isabel Net. We're dealing with the month of February right now, and we're looking at the year 4 of the president's term. And what are the monthly averages? And this goes from 1928 up till now, where February tends to be down. And you'll see later on seasonally where the early to middle part of February tends to be stronger. Seasonally, we tend to see some weakness as we go further into February and then into March after that. So just something to be aware of there. And then looking at our valuations, where the U.S. still has the strongest or highest valuation levels. This is over a 20-year period of time, where we're coming in at 20.6. This has more to do with the PE ratio and what I go over in the weekend videos, where the range should be down in this other area, but we're pretty high right now. Then we're also kind of expensive when we look at the whole world. We're above this range, but we're still below the 20 level. And then you can see some of the other countries going out. Then looking at what Goldman Sachs is thinking will happen at the beginning of the year, the markets were pricing in a potential of 6 rate cuts. Well, they've kind of scratched off the first one, and now they're looking at 5 rate cuts, and this is what they expect to have happen going forward. Who knows if this is really going to play out this way. This is looking at GDP. When you look at the whole globe together, we do have positive GDP. When you look at advanced economies, which includes the US, that's also looking good. And then emerging markets and developing economies, they're also looking positive. So from a growth projection point of view, we are looking at growth across the whole globe. Then this is what are most people in right now as far as their positions. You have tech, number 1, and financials. This could, if we are starting to get through the eye of the hurricane to the other side of the storm as far as the financial sector is concerned, this could really pose some problems for the market. Now, we don't know that yet, but a lot of folks are in financials, and if they really start to show some weakness, we would see money coming out of that, and that could produce more of a tidal wave throughout the whole stock market. Then looking at the smooth recession probabilities, I'll show this chart again over the weekend, where we're barely coming back up to the black line. When we get nervous is when we get up to the red line. So this is not suggesting that we're going to go into a recession based on this chart. Looking at large cap versus small caps, it's not really a surprise here. The Russell 1000, those are large caps, and they continue to outperform the Russell 2000, which are the small caps. And we were hoping to see some kind of January effect here, and it lasted in December, but then just seemed to go away in January. And then these are the cumulative flows across different regions, where most of the money now is going into Asia Pacific. If you remember back a few videos, there's some real optimism when it comes to Japan. And so we're seeing money going in there. We're also seeing money going into emerging markets. This darker line, this is the US, and then this light blue line is Europe. All right, let's go back and look at our analysis here, where we did gap higher above the daily pivot. We tried to go up. We hit this resistance at 48.75. Then we fell back down below the daily pivot. And it like, okay, well, we kind of filled the gap here. So that was kind of interesting. We never got down to the unchanged level, and we could have really fallen apart at this point. But buyers came in. We went back above the daily pivot. We got up to R1. We hit some resistance at that level for a while, and then we were able to break above that. And then finally, near the close, we got above the 4,900 level and closed at the high for the session. So that is positive, but we still haven't recaptured this gap that we saw before Wednesday's session. So we need to fill that if we're going to turn back more positive. Intraday, we were looking better in the initial overnight session. Right here, this is the pink area where we were seeing a bit of a recovery. That did carry through into the pre-market session. Here's the cash session where we closed pretty much at the high. And we're looking pretty good right now in the initial overnight session as well, as more earnings reports are being released. When we look at the intraday chart, though, we're still seeing the red line above the blue line. Growth is showing some improvement, but not enough for the blue line to go back above yet. So when we look at the ratio, we did see where growth ended up outperforming value. So that is showing some improvement there. Our end of day chart, where growth was up more than value for the large caps, the mid caps, and a little bit more for the small caps. Here's our other end of day chart. We're going back up a little bit with this growth to value ratio. We want to see this continue to go up for it to be more positive. Discretionary and staples ended up being up in Thursday session, so our ratio down below really didn't show much of an improvement. This is a longer term negative divergence where we're not breaking out with the ratio where we have been breaking out with the S&P. That's a warning sign. And here's where we're starting to drop below the moving average with our ADX. The green line's on top, even though it is declining. It's still picking up that gap that we created in Wednesday's session. Shorter term, we're also dropping below the moving average, and the green line's on top, but it is declining. We are picking up with volume, and we're above average there. Looking at sentiment, we're going back up a little bit here with the Ulcer Index after giving a very low reading. We did see a decrease with the VIX on the line chart as well as the bar chart, but we're above the moving averages with both as volatility picked up in Wednesday's session. And we're seeing a decrease in the VIX of the VIX as we had an up day. So that's starting to fall with the bar chart as well as the line chart. And the equity put call ratio continues to fall. That could be positive. This is the daily chart, and we're still going down for 2 days now with the 5 period. So this could be more positive for the market. We're still really near this red area. We're just at the lower end of this. We spiked up, started to come down. So the market is still anticipating some kind of a big move. We don't know if it's going to be up or down, and it's kind of a coin toss at this point. We're looking positive with our charts, but after what happened on Wednesday, we know that the market has the ability now to do some real intense selling if it comes to that. We did get the latest reading of the American Association of Individual Investors. They're above this one area, but they're not necessarily extreme positive. We look at the moving average where it's above zero and advancing. We can still go with this for right now because when it gets above this pink line, that's when we start to use this as a contrarian indicator, and we're not quite there yet. The advanced decline line, we did see some improvement, and we're actually showing a lot of improvement here based on price. We haven't quite come back to this previous high yet based on volume, but we are seeing some improvement. With our new highs, we are seeing more new highs than new lows. We're turning back up with the 5 period, and we're also continuing to advance with the 10 period. We did tick back up, and we're positive with the advanced decline ratio. We also turned up with the accumulation distribution. The Chaikin money flow is showing some improvement again, and the Chaikin oscillator is ticking back up. So we're looking a little bit better when it comes to the smart money. It's almost like the smart money said, okay, let them do whatever they want to do on Wednesday. They'll do as much damage as they can, and then we'll come back in on Thursday and do some buying. It seems like that is what happened there. That's pure speculation on my part, though. We did see an improvement with the NYSE advanced decline line as the S&P ended up going higher. And when looking at our advanced decline line studies, we saw some improvement with the NYSE common stock. The S&P advanced decline line has been holding up fairly well. We haven't quite shown as much improvement with the mid caps, and we're bouncing off the moving average with the small caps. Here's our daily chart where we came down and then we just kind of shot right back up here. So not a lot of damage has necessarily been done to this point. We just want to see, okay, what's the market going to do to react, especially to the employment situation report. And where we were extreme down with the rate of change for 1 period, now we were extreme positive with the up day. The wins percent R is now back to looking extreme positive. We are turning up with our 20, 50, and 200-day moving averages. The force index, which dropped to negative and actually hit the Keltner band, it bounced back up and is now positive, but it's still below a declining midpoint. We're extreme with our stochastics chart in the short intermediate, even though it's declining. We're turning down, but still extreme in the long-term stochastics chart. We're not extreme here with the standard deviations chart. We did go back up, but we're in the +2 area. We didn't quite get up into the +3 area. The balance of power did show some improvement and is still above the midpoint. We're still positive here, but we have the lighter shade of blue bars with the go, no-go system. And we're still above the midpoint with our highest high value. We've come down a little bit, but we're still hanging in there on this chart. The TTM squeeze is now switched back to a lighter shade of blue. That is more positive. We're turning back up finally. After seeing the ease of movement going down for a number of days, it did start to tick back up. The Arun's just kind of floating along. We're seeing a little bit of decrease in buyers as well as sellers, and so our oscillator is really unchanged. This is a little bit of a concern here. The S&P on an update, it's still below zero with the McClellan oscillator. We want to see this go back above zero. So we're continuing to decline based on price, but we're starting to go up based on volume. Sometimes volume is a leading indicator here, but sometimes it can also fool us. We did go back above zero with the NYSE McClellan oscillator, so that's more positive when we look at the broad market actually doing better than the S&P. So we're starting to turn back up based on price, and we're just barely turning back up based on volume with the NYSE summation index. We're continuing to decline, though, with the Swenlin trading oscillator based on price and volume. And we're kind of chopping around right now. The PMO is extreme positive, and it's trying to come down to its moving average. We were trying to turn up based on price, but then we're starting to go back down, where we're right on top of the moving average when we look at volume. We did see some improvement with the PMOs that are rising. We're turning back up slightly with the buy signals. We're still extreme positive with the PMOs above zero. We've switched from being negative back over to neutral for the Elders Impulse system for the S&P. We're still positive with the parabolic SAR with the dots underneath. And this is the slope oscillator where it's coming down, but it hasn't quite crossed below its moving average. However, it is giving us an extreme positive reading. The MACD is starting to roll over below its moving average. So we're getting some kind of mixed signals here. The slope is rolling over, but still above the moving average, where the TSI is actually crossed below the moving average. That's kind of a contradiction there. We're turning down with the MACD. We're rolling over with the PMO. We're just barely positive with the PPO. And we're still looking positive, though, in the long term with our oscillators, the TRIX and the KST. We're still above all the plotted moving averages. I brought out the 20-period moving averages chart for yesterday's video, but since we went back up, I'm not including that chart again here. We did decline a bit here with the bullish percent index on an up day. That's a little bit of a concern. After getting extreme, we've now dropped below 70. And we did tick down a little bit, but we're still above 50 with the NYSE bullish percent index. We did decline with the NASDAQ 100 bullish percent index. That's a little bit of a warning sign on an up day to see these decline. We're not extreme, but we're going back up with the money flow index. We ticked back above the midpoint with the ultimate oscillator, so we're turning back positive. The vortex is starting to turn back up with the green line. That's positive. We're no longer extreme and turning back up with the RSI based on 14 and 9 periods. We're still above an advancing moving average with on-balance volume. We're going back up with our 250 period moving average studies when we look at stocks inside the S&P. The Copic curve is starting to show a little bit of an improvement here and is positive. We're still kind of extreme here with the Sean trend meter, and it turned back up. Our different charts, we're still looking kind of negative here with the Heiken Ashi. It's going to need to see some more improvement for this chart to turn more positive. We have turned back to positive, though, with the Kegi. It's a black line, and it's pointing up. We're also still looking positive with the Renko chart. We're still looking negative with the 3-line break. Long term, we're still looking extreme with our 150 and 200 period moving average studies. We did see the equal weight S&P outperform a little bit of the S&P 500. No, I take that back. It was the other way around. The S&P did outperform, but we are seeing some improvement with the equal weight. And that's why we saw the ratio actually going up just slightly. It virtually was unchanged, but the mega caps did outperform. We're still seeing this longer-term negative divergence between the Dow on top and the transports in the middle. That's longer-term negative. And we're still seeing where the transports are underperforming the Dow. The Dow hasn't gone and really, I guess it just barely set another new all-time high here, but not by very much. And we switch back over to positive after being neutral with the Elders Impulse system when looking at the diamonds. We're coming back up to right where we were with the NASDAQ. We're also continuing to be in no man's land with the Fibonacci chart for the NASDAQ. And we're also coming back up to where we were with the NASDAQ 100. And we switch from being negative back over to neutral for the QQQs when looking at the Elder's Impulse system. This is a warning sign here. The NASDAQ 100 is crossing below its moving average based on momentum, so that is a concern. The small caps just kind of continue to chop around. We were able to get back above this pivot point here. We've gone from being negative to neutral for the small caps when looking at the Elder's Impulse system. And we're still below this resistance level here. We're not able to recapture that yet. We are showing some improvement with the RSI. We're right at 50. And this is all based on the Russell 2000 small caps. Longer term, we still have an uptrend. And we're continuing to go back down again now when we look at our shorter term momentum for the small caps. The mid caps were able to recapture and stay above this pivot point. And they've gone from being negative back over to positive when looking at the Elder's Impulse system. The FANG index did bounce up, but did not set a new all-time high. The financial sector, it ended up being up, but it had been showing some weakness. And right now, the weakness that we're seeing is in the regional sector. And I'm going to keep an eye on that. And I usually go over that chart over the weekend. The dollar ended up being up slightly, even though we're still in a longer-term downtrend. We are declining when we look at the 10-year yield. We're going up with the 10-year based on price. We're crossing over with the MACD. So the momentum is turning positive after it had been negative so far in 2024. Looking at growth of value, we're not really seeing much of an improvement from the Qs to the S&P. We're still lagging behind when we look at discretionary to the S&P. And again, a lot of that has to do with Tesla. We ticked up just a little bit, and we're barely above the moving average when we compare large cap growth to large cap value. So with the large caps, seeing a little bit of an improvement with the mid caps, and seeing actually a little bit more improvement with the small caps. We're still extreme positive with our 10-day average of the S&P 500 highs minus the lows. We're still positive when we take the 5-period moving average of the highs minus the lows and look at the broad market. That's pretty positive. We continue to decline with the 2-year yield, which could continue to give support to the S&P. So what's our outlook for Friday? We still have been dealing with a really heavy earnings week. About 20% of the S&P 500 companies have been reporting. Our trifecta is now giving us a score of 1 positive to 2 negative. So when January ends positive, for the rest of the year, when you take it all together, we end up having gains of about 20% for the year on average, and we were up 1.6% for the month of January. The technicals are positive. We're still looking at this overbought condition, and we still have to ask the question, is weakness developing in this whole scenario? We need to see follow through from here. Then the economic reports, we're going to get the employment situation report, factory orders. The other big one is going to be consumer sentiment. And then keeping an eye on the geopolitical events and seeing if they have an impact on the market. And then I'll have the new calendar when I do Monday's video. So we've completed all of the economic reports. Looking at seasonality, we're neutral to positive with the Dow. We're flat out positive with the S&P. We're neutral to positive when we look at the NASDAQ. So we see a little bit more strength when it comes to the NASDAQ for February 2nd. And here is the month of February when we had a good January. That tends to bode well going forward, at least till we get to about the middle part of February. And then this is also showing how February often tends to start out. We're looking at the orange line. We're pretty flat, but then we see some more strength going into the latter part, which kind of contradicts some other seasonal charts that we look at, where we often show some weakness as we get into the latter part of February and then into March. That's kind of also what the Stock Traders Almanac chart is showing as well. And then we're starting to do a little bit better here when the sitting president is running for re-election. We tend to see some more strength in the earlier part of February. Friday's session tends to be the second best day of the week based on what happened in 2023. We will be on the second trading day of the month, where we do see a little bit of positive seasonality with the green dashed line. And then for the month, the S&P is up 40 times. It's down 34 times. So we're up more than down, but we end up having a negative return for the month. And then here's Dan Bird's chart, where we're coming into that period of time we're over here now. We're at the beginning of February where we tend to chop around. It's later in February where we start to see some weakness, and then sometimes that goes into about the middle of March. Not saying that's going to play out this way, but this is what seasonally has happened going back to 1950. I just try to want to warn you ahead of time so that you can be aware of that. Our scenario's not going with the downwind yet, although weakness may be developing and we are dealing with an overbought situation. We're still positive when we take all of our charts together. So if anything, we still go with the up scenario, especially if we end up looking to have a close up in Friday's session. We're not going with the sideways trend now because our ADX is above 20, but we are dropping below the moving averages. And if that continues, we will eventually drop below 20, but we're not quite at that point yet. The warning signs, the risk on, risk off posture, we're just that chart just isn't helping us right now. And we're still watching this longer term negative divergence between the transports and the Dow. Growth has been showing some signs of improvement. We want to see that continue. The equity put call ratio continues to go down. The oscillators are improving. Some of them are extreme. Some of them are starting to drop below their moving averages. So they're positive, but we want to keep an eye on them. The parabolic SAR and the vortex charts continue to be positive. The bullish percent index, it's no longer extreme for the S&P, but it's still extreme for the NASDAQ 100. And it did decline on an up day. That's a concern. The Copic curve is positive, but the momentum, I should have changed this. This is actually switched over to negative now. Small and mid cap growth is still positive, but we're getting a little bit more up into the upper range of that sideways range that we've been in. The financial sector, it's positive for right now. We want to keep an eye on that. Our conclusion, we're still positive, but we're overbought. We want to see areas of weakness. Are they continuing to develop or are they going to go away? In the short term, this is really where we're watching this. In the intermediate term, we continue to be overbought. We're also looking for signs of weakness in the intermediate term. We're still positive in the long term, but we continue to be overbought with those moving averages being extreme positive. Thank you. I really hope you found this helpful. Have a really good day, and I will talk to you in the next video.